Welcome back, ladies and gentlemen. So just how much equity does the average retiree hold today? For that, we go to a recent column in Investopedia, and it really speaks to the largest asset that many retirees are holding today. It says the median home equity for homeowners 65 and older stands at $250,000, according to Harvard analysis of the most recent federal data. And that is 47% higher than it was in 2019. Of course, we know why it is that much higher because of the post-pandemic boom in home values caused again by the Federal Reserve. So there's no sign that that is going to be dropping. Now, our next story is going to look at the markets where home values are falling, but nationally, home values are remaining stubbornly high. According to recent data from Normalist Risk-Span Reverse Mortgage Market Index, Americans 62 and older hit an all-time high of $14.39 trillion in home equity in mid-2025. Noting that for many retirees, especially those that are Black and Latino homeowners, that home equity represents most of their net worth. Obviously, home equity does rise with age because these homeowners have held their mortgages for several decades in most cases, and they've had the opportunity to pay that down. Also, they have owned their home during periods of appreciation, especially rapid appreciation we've seen in the last 4 years. But don't forget, even moderate appreciation can accumulate a tidy sum of housing wealth. What's interesting is that the Kaiser Family Foundation notes that among Medicare beneficiaries, the median per capita home equity increases from $134,450 for those 65 to 74 up to $179,700 for those 85 and older. And so that makes sense. Older homeowners are more likely to own their home outright. And if you may notice that that number is a little bit lower than the average median equity held by older homeowners because they're Medicare beneficiaries. When it comes to net worth, it's not just investments or home equity that has the largest impact. Of course, it is an older homeowner's earnings. In fact, recent data from the Transamerica Center for Retirement Studies found that retirees with incomes between $50,000 and $199,000 reported a median of $253,000 in total household savings, which excludes home equity. Also, baby boomers with lower incomes have 3.8 times their annual income that is locked in the bricks and mortar of their home, according to Vanguard, compared with 1.1 times for those that are top earners. Unfortunately, the reality is that there are significant disparities in home equity held and income when it comes to different racial groups. The Urban Institute found that home equity makes up 81% of the total net worth of Black homeowners 62 and older, and 89% for Latino homeowners 62 and older. While for white homeowners 62 and older, it's only 47%. Home ownership is nearly ubiquitous amongst our older population. About 4/5 or nearly 80% of Americans 65 and older do own a home. But the picture is a little bit more murky when it comes to what's happening with mortgages. Those that are 75 and older who are still carrying a mortgage has tripled since 1998, increasing from 11 to 30% by 2022. So what we have are more retirees that are entering their non-working years that still have a mortgage payment, and that is a significant financial burden. Our next story comes to us from Housing Wire's Reverse Mortgage Daily, revealing that Mutual of Omaha Mortgage topped the rankings throughout the calendar year 2025 for HECM loan endorsements, that despite a rather tepid and stagnant home equity conversion mortgage market last year. As reverse mortgage professionals know, the last quarter of 2025 was a bit rocky as we encountered a 43-day government shutdown. That is the longest in our history, sadly, and that led to no endorsements being recorded in the month of October. That created some real friction when it came to endorsements, of course, but also the ability to package these loans and to sell them to secondary investors. Yet despite that, Mutual of Omaha endorsed 447 HECMs in December, and that brought their total for all of the calendar year 2025 to 5,740 loans, down from 6,149 in 2024. This according to data that is compiled by Reverse Market Insight. Also last year, the company entered the proprietary reverse mortgage market with their April launch of their Secure Equity Plus product. Next, in calendar year 2025, we have Finance of America, or FOA, who followed closely behind Mutual, endorsing 352 HECMs in the month of December, finishing 2025, that is a calendar year 2025, with 5,107 loans or HECM loans endorsed, down from 5,946 in 2024. Now, despite those declines, the company has continued to position themselves for long-term growth, most notably in a recent agreement in which they will acquire $9.6 billion in mortgage servicing rights from the Onity Group. And speaking of the Onity Group, which is the parent company of Liberty Reverse, Liberty will be exiting the reverse mortgage origination space, and they closed 105 loans in December. That brought their 2025 total up to 1,166 endorsements, making it rank 5th nationwide for calendar year 2025. Then there's Longbridge Financial, a subsidiary of Ellington Financial, who posted one of their stronger growths for the calendar year 2025. In fact, they originated 404 HECMs in December, but 4,146 HECMs for all of 2025, and that's up significantly from their 2024 total endorsements, which were 3,299. In September, Longbridge also broadened their product offering with the launch of the HELOC for seniors for those 62 and older. So what can we surmise from these particular statistics? One, and most notably, is that reverse mortgage lenders, and yes, you, the professionals watching, are increasingly resilient, even more so than in previous years, learning to navigate this challenging market and those factors that we have no control over more efficiently. And of course, we have diversification. Again, I want to remind all of us that these HECM numbers do not represent the entirety of reverse mortgage originations, as roughly about 35% of the reverse mortgage activity nationwide can be accounted for in the proprietary or jumbo reverse mortgage market. Increasingly, understanding your local and regional housing market in those areas in which you are marketing and originating reverse mortgages is no longer an option. It is mission critical because, as you know, all real estate is local. So today we're going to look at the cities in the U.S. that are projected to have the biggest drop in home values. Again, these are projections, but Newsweek looked at recent data from Zillow and Realtor.com and gives us the 10 U.S. cities and metros where home values are declining the fastest and projected to drop even more. Of course, what comes up must come down. Those hottest markets, especially in the states of Florida and California, have a very good representation in this list of cities where home values are dropping. However, on a national level, home prices are expected to rise by 2.2% year over year by the end of 2026. So housing corrections are based on a number of dynamics, and one of those is local inventory, and the other is the number of price cuts, that is for home sellers, because it shows that the market is softening. So let's dive into the list and see which cities are expected to drop even more. Experts expect next year to bring slight improvements in housing affordability, yes, thanks to home prices falling in several markets, and that will help bring some buyers back into the home buying market. And these are the metros which are expected to experience the largest drop in home values in 2026. And look at that, Cape Coral, Florida, 10.2%. Now that's after they've already had a previous decline in 2025. Northport, Florida, expected to drop 8.9%. Stockton, 4.1%. Raleigh, North Carolina, 3.7%. Deltona, Florida, almost sounds like Daytona, dropped by 3.6% in 2026. At least that's the projection. Same for Tampa. Spokane is nearly the same. Same goes for Denver and Sacramento. And then San Francisco, once one of the hottest markets in the West Coast, is also expected to decline by 2.5% this year. So here's where housing growth is slowing the quickest, and we can just kind of mouse over this in this Newsweek column. By the way, we do have links to this story on HECMWorld.com for this podcast episode, so you can see the drops that we had just reviewed right now. When it comes to the drop in home values, Florida stands at the top, and that is thanks to a reversal of the pandemic migration, which brought many people to the Sunshine State. That is no longer the case. In fact, many are actually moving out of the state of Florida due to sky-high property taxes on unaffordable homeowners insurance thanks to natural disasters in the state. And then the condominium assessments are squeezing many older homeowners out of Florida, and they're moving to lower cost areas. Now on to the Golden State. 3 California markets, Newsweek says, are expected to face steep price declines, and those are Stockton, Sacramento, and San Francisco. High prices and the drag of high mortgage rates continue to eat into housing demand, which could cause home prices to soften. To wrap up, equity trends, of course, are not uniform. It's all going to be localized based on several factors in the markets in which you're originating, so you'll want to be watching those very closely. It doesn't mean that you shouldn't be originating in those markets, by the way. That's not what we're saying. But you want to be mindful of where you might see some challenges in appraised values, especially for those that are right on the cusp of being short to close. So keep that in mind when you're looking at these markets that we just discussed and where home prices are expected to decline the most this year.